Hello and welcome to Exchanges for another week. I haven't had somebody in on investing for a little while, so I thought it was probably about time to get one of the brightest minds in that space in Australia on. John Addis needs no introduction, the founder of Intelligent Investor and a really, really deep thinker when it comes to investing, about how it works, where to look, what to do, the rise and rise of passive investing and what he thinks about that as well. But also just to have a really good exchange about exchanges. And that's why John Addis is the man to listen to today. And I really do hope you enjoy our conversation and the banter that we get involved with. John Addis, welcome to Exchanges. Your whole history has been based around, the intelligent investor and what you've done, value fundamentals, etc. Question for you right now, though, is fundamental investing dead?
Well, we're still doing it, so I'd argue not.
Yes. Yeah.
But I can see why you might ask that question because, the growth of index investing, which is the opposite of fundamental investing. You don't look at anything other than the constituents of an index and build a fund to reflect the constituents of that index. That's the opposite of fundamental investing, and it's becoming very, very popular. Most of the money in the market now is fundamentally, there's no fundamental analysis involved at all. So I can understand why you're asking the question, but somebody's got to set prices, right? Somebody's got to say, we think this stock is worth this. And at the moment, most people in the market are not paying any attention to that. So I don't think that fundamental investing is dead. It's definitely not the thing of the moment. And I think 50 years ago, before John Bogle and Vanguard, you could argue that there was way too many people doing fundamental investing, and the proportions were wrong. And maybe the proportions are becoming a bit wrong on the other end of that spectrum now. There's not enough people doing the work that will give you an idea of what a stock is worth. But that can change very, very quickly. And I expect in the next few years it will.
So many parts of that question that I've got to ask you for that answer. I've got to ask you. So first and foremost, with passive investing, one of the things that passive investor houses, let's call them what they are, we'll come back to you with regards to the flow of funds through passive and almost the ignorance is probably the really harsh word to use around using it, is that if that was the case, you'd have this complete distortion. And you've over the last, let's use what's happened in Australia over the last 6 months, like BHP, Rio Tinto, etc., haven't moved anywhere near the amount that sort of banking fundamentals have, which are, CBA is the largest company, BHP, Rio not far behind. How do you sort of go back to them on that question, saying, look, because I'm with you, like at the moment, the flow into passive is clearly ignoring things and it is creating distortions, but they would suggest it isn't.
Yeah. No, I disagree with that. I mean, we talk about this. We just had our Monday meeting call, and it's normally the same thing. It's like, if somebody says, how can Commonwealth Bank be on the PER it's on right now? And when you go through all the explanations for it, the flood of money into passive investing is probably the best explanation for it. People aren't paying attention to prices. So it can't be the entire explanation, because you look at, say, the market cap of BHP versus Commonwealth Bank and the way their PERs have changed over the years, and not that PER is a good way to value BHP or Rio. But there is something else going on. But I do feel as though dumb money, which is what I think passive investing money is dumb. It's not paying any attention to anything other than price, when I think the value is the other side of the equation, is driving a lot of increases in the market these days. You can see it much more than you did 5 or 10, 15 years ago.
I was going to come to this towards the latter end of this interview, but we're going to do it now because you said something before that piqued my attention around we maybe don't have enough fundamental analysis going on. Where does AI sit in that answer? Where is AI in the fundamental analysis of markets, stocks in the future with that kind of concept going forward?
Well, it definitely makes it easier. Like, it makes your research process easier, I find. I still think that any numbers you ask AI for, you really have to double check. You have to go to the sources and check it. You can't just say, give me 5 years worth of Apple's annual reports. and present them in a table and assume that those numbers are correct, because
Hmm.
I've done that a few times, and they're
They're wrong.
really, really not. So, but things like competitive analysis, it can be really, really good. When you're doing sort of background checks on people on a board, it can be really useful. So it can get you a lot more information more quickly. You just have to not shoot. You have to assume that some of it is wrong. And the problem, I think, is that for a lot of people, if you don't know a business, you don't know its competitors, and you assume that the information's right, you don't get that sort of sense check if you don't have that kind of background. So I think it's going to be useful. It's clearly going to be a lot more useful. Whether the AI enthusiasm is driving market prices, I think that's part of it too. It's not just passive money. People are getting very excited about AI and what it means, and it does feel a bit like, I don't know whether it's 1996 or 1999. I don't know, but it does feel like that dot-com period.
So that was only my next part of this. Is you've got Nvidia now, which is a four
I've got
point.
all your questions here, Evan. I can see them all before you ask
You're
them.
just doing my job for me in terms of what's going on there, John. Like, because Nvidia is now what, a 4.3 trillion US dollar company as you and I sit here and speak. Microsoft is not far behind it. Apple's catching up again. Is this hype? Is this, as you said, 96, 98, 99? Would it even be a new version of 2008 with regards to, the GFC in terms of the AI FC or whatever you want to call it? Has AI now got to that period? Because I know you did a really amazing article a couple of weeks back around, are we at inception, frenzy, you know, adopters,
Yeah,
and then maturity? I would argue we're clearly at the start of that level.
yeah.
Where is it, and what do you see as the future, particularly in the short term, as in the next 5 years, about how that transition goes
Mm.
through the cycle?
I would say, like, I don't think, if this does go badly wrong, I don't think it's going to be a GFC. I think that the GFC was a financial crisis, and the banks are not in anywhere near the same position they were. Some might be, some of the smaller banks, but I think we're really unlikely to have a financial crisis on the scale that we did. Famous
Mm.
last words. We might see a bond crisis at some point.
Yes.
I think that's quite possible. But in terms of a financial crisis, I don't think we're going to get that. I do feel as though if there is a parallel, um, the dot-com bubble is a better parallel than the GFC. And I think the story you're referring to, I've got it right here on my desk now. I will show it to your listeners. Seems a bit weird, so show it to your listeners. This is a book by Carlota Perez, Technological Revolutions and Financial Capital. It's an excellent book if you're thinking about technological based bubbles, and goes all the way back to the railway era, where there was a massive investment, over expansion in capital. And I was reading about the history of UK railways, because my mum always moans about Beeching, who cut the UK rail network by about 40% in the 1960s. But they kind of needed to do it, because between Leeds and Halifax, there were 3 different routes. It's only 26 kilometres, and there were 3 different routes you could travel between Leeds and Halifax, and you could walk from one train station to another.
Right.
It was kind of mad. So you had to cut 2 of those lines out. So you get this massive overinvestment in a technological revolution. And I think you can argue that we can see, when you look at the capex that the Mag 7 are doing into AI, it's absolutely astonishing. And there's no guarantees that the people who own the railways, the people who own the data centers, are the ones who are going to profit from it. Often the revolution, the benefits of the revolution are spread much, much more broadly. So I think that could be a useful parallel when you're thinking about AI and who will benefit from it. Like, I'm definitely benefiting from it. You're probably benefiting from it.
Mm-hmm.
It's not guaranteed that Google or Amazon, or well, maybe Amazon's different. I mean, they've got the data centers. I think we can safely assume that people are going to be using more data in the future. But beyond that, the intelligence itself and the products that come from it, it it's very hard to say. So I think that the dot-com parallel is better than the GFC. And I do feel as though we're approaching that sort of bubble environment. I feel it does feel pretty overexcited.
Yeah, it does. That's why I wanted to, because the dot-com bubble to me was always that sort of dog eat dog. Who would come out on top? No one could ever tell you. Now, obviously, hindsight's a beautiful thing. Google won
Yeah,
in terms
yeah,
of where we got to with the search engine. The
yeah.
next one I then ask you about is,
are we also possibly going through a bit of a revolution like social media where,
Hmm.
nobody knew who was going to win social media? We had, several goes at it that looked like we'd been a winner with MySpace, etc., and those kinds of things, Vimeo,
Hmm.
blah, blah, blah. But Facebook's clearly won. Is that the other part
Yeah.
of this? Is that it could be OpenAI, it could be, DeepSeek out of China, it could be another player. Gemini is clearly not
Yeah.
working for Google. Is that the other part of this sort of scenario that you see in historical lookbacks of,
Yeah.
yeah, we're going through a period now where there's almost an arms race in terms of where
Hmm.
we sit?
Yeah, I think you just don't know. Like we all look at Amazon now and go, well, it was obvious they were going to be the winner, but it wasn't. You look at
No.
Google and say it was obvious that they were going to be the winner, but there was LookSmart, there was Alta Vista, there was Ask Jeeves,
Yeah,
there was
and
20 or
and
30
Yahoo.
different search engines, and Yahoo, which were incredibly when you think about it,
Yeah,
like building directories of the internet, like link by link with people. And you just don't know. And Google kind of got lucky with a very, very good idea, which was ranking sites according to the number of links that they had, which was deemed as sort of a way of being able to trust the source. And that's what really built that business. We are at the same stage now, I feel. I mean, OpenAI's got 700 million users from ChatGPT. You say from a retail perspective, that is a really, really good business. They've got billions of dollars of revenue coming in. So it's different in that respect. In the dot-com bubble, there wasn't any revenue. No, they use that phrase pre-revenue. We're not hearing that now. All of these
yeah.
companies have revenue, and the CapEx is being done by some of the best businesses in the world. So it is different. But whether the entire thing is different this time, I don't think so. I think normally this looks like a classic kind of technological bubble, and you don't know who the real winners are going to be. And it might not be AI, and it might not be the Mac 7. We'll just have to wait and see. But the enthusiasm in their prices isn't huge, right? You can look at Google and say, well, I think that PER is about 19, so it's not excessive. People are pricing that as if their ad business is going to go down the toilet. Meta doesn't look ridiculously expensive. So we haven't reached that real period of
Frenzy.
crazy enthusiasm where people
Mm.
come up with a wild idea and venture capital comes along and says, here's $20 million, go off and float. They're investing in what look like real businesses rather than just business plans at the moment. So I think in that respect, it's different too.
So that also suggests that, capital has learned that it's not just, as you said, basing off a laptop in somebody's basement. It's actually basing off
Yeah.
the revenue and the profit behind it. So we have learned from it, because then it brings me back to Australia and where
Mm.
Australia sits right now. We continue to show that we've got a record ASX 200 as of the close of when you and I are speaking, which is on the Monday after the record close on the Friday the 15th.
Mm.
But for me, my question to you is, we've always prided ourselves on the barbell, which is, financials one end, materials at the other end, and everything in the middle makes up the bar. Are
Yeah.
we actually modernizing enough, or are we just again resting on our laurels and being happy with being, inverted commas, the lucky country and getting away with it? Because I don't see us being that lucky if we continue to think like this.
Mm. That's a good question. I do feel as though it's different. Like, we had this exchange last week where people were saying, well, the banks are too big. I feel as though that's a broad world problem, that we've got a financial sector that is way bigger than what it needs to be.
Mhm.
And that's a lot of misallocation of brain power and a lot of misallocation of capital. A lot of the products I think they produce are unnecessary. Can't say that about resources. We do need resources, and you can argue that Australia in the past has suffered a kind of Dutch disease where our focus on resources has made us lazy in other areas. But I think that's becoming less true. So
Mhm.
you look at our tech sector, the quality of the businesses that we've got in our tech sector. There's not many of them, but there's a lot more than what there was 20 years ago. You look at, say, Life 360, Wise Tech. These are Pro Medicus. I mean, these are
Mhm.
these are really, really high quality, high growth businesses that have been founded here in Australia. And it used to be a sort of shibboleth that if you had an Australian company going overseas, like when NAB bought Yorkshire Bank, or when I don't know, like every big company you can think of 20 years ago, when the REITs went over to the US and bought up loads of US shopping centers and office blocks, and
Yep.
almost
Wesfarmers.
every time it was just like a massive, massive disaster. We're not seeing that to the same degree now. The companies that should stay here are staying here, and the companies that are expanding overseas and should are doing a good job of it. Even in retail, like you can look at Lavisa and go, well, that's a kind of becoming a global success story that was founded here. Smiggle, not so much, but we're doing it a lot better. So I'd say that just from my limited knowledge of, listed companies and what I see, I would say that we're becoming medical devices is another area, right? Where we've got globally significant companies. There's Cochlear, CSL, ResMed. There's more and more of those kinds of companies. So I think we are becoming a more diverse and more sort of creative kind of economy where we are developing globally successful businesses. We're not yet Sweden, which has got 10 million people and lots of international, globally significant companies. Denmark, same, but we are getting better, I feel. I don't know, you're the economist, Evan, you tell me.
Yeah, so I'm with you in the fact that the one thing that you have seen. So you pointed out our failure stories in the previous generation, and the one that highlights to me is we also need to know the economies you're moving into. So for me, it's Wesfarmers when they attempted to take Bunnings to the UK,
Yeah,
and
yeah, that's a
I mean you're
disaster.
born in the UK, and I've lived there,
Mm,
and when I saw it, I was like, the Bunnings
what are you
model
doing?
will not work in the UK. And they're like, "What do you mean?" I said, It's a high presence business, really high turnover with low margin, and it needs to have a community, because this is what it is. It needs to have a community that is highly engaged in that activity, and the UK is a do it for me
Yeah,
economy. It's not a do it yourself economy like Australians
right.
sort of pride themselves on. So I remember seeing that one. So I'm with you in terms of the other one that, you look at the Australian companies that you've just listed, particularly that are going overseas, and the ones that we don't talk about enough are things like Canva. You look at what they're doing. I mean,
Canva, perfect
yeah, the
example.
majority of their earnings comes from international. I mean, that's
Yeah,
I would argue we're lucky it's domiciled here, but that could be anywhere, right? That's what
yeah,
Canva is. It could be done anywhere, and it's the same with Atlassian in terms of what's going on
yeah,
with Atlassian.
yeah.
So from the economics of it is fascinating because it's borderless companies. That's what you've
Mhm.
described. I would
Yeah,
argue that that's where we're going down. We're going down borderless
right.
companies, and borderless companies are now having a massive issue for government, because this is my next question. You and I are filming this at the start of the economic roundtable here in Australia, and
Yeah.
about how you
There's a
deal with.
phrase to sort of kill the spirit. You
Yes,
know
it
that
is.
nothing's gonna come of this.
Like I've already said, I've said this publicly. I've been saying this when I do radio, and doing the program that I'm currently hosting, or wherever they'll have me on. This is like, we are about to see some incredible political theatre. Like, it is
Yeah,
that clear. It is
yeah,
just
yeah, yeah, yeah.
beautiful political theatre, and it's why I asked you the question before about companies. What you're hearing from them, and this is my question back to you, is that the one thing that is also clear from the companies you listed off, your Pro Medicus of this world, your WiseTech of this world, they are the success stories. And finally, they're starting to work their way up into the top 50, top 20 listed
Mhm.
companies in this country. But again, the capital allocation from passive investing, but also just the incredible regulatory hurdles that are involved within, listing these days and all of that
Yeah.
material. Is that something that you think we need to really go back to and look at? Have we done, which is what the Productivity Commission has actually released over
Mhm.
the weekend on the 17th of August, which is that we overregulate too reactively and then are too slow to unwind what is clearly a reaction rather than an actual proper movement forward.
Well, that's a bureaucratic mindset, isn't it? That's how
Mhm.
it happens in every area of life, and if you're looking at productivity, I think, in the housing market is a classic example. Every tradie I get into my house moans about all the stuff that they have to do to comply with the regulations. And we should have safe building sites and stuff like that. But it seems to they're all moaning about it. So it just gets in the way of doing our job.
Mhm.
And I think you can apply that for everything. In terms of listed markets, if you look at the money that's being raised, we were talking about AI earlier by um, private companies in AI, or that's where all the money's going. There's
Mm.
no shortage of funding for AI, but most of it is coming from private markets. It's not coming from public markets because the regulatory burden in public markets is quite high.
Yep.
And the regulatory burden of private markets really doesn't exist. And why would you want to tell your competitors what you're doing? So
Yeah.
I think it is a problem. It's especially a problem for small markets like us, and a problem for the ASX, one of the most incompetent sort of regulators on the planet, I think. But
That's an
if
understatement.
you can get your so if you can get private money and not have to go public, then why wouldn't you do it?
Yep. And that's what we've seen. So I'll get back to Canva because you've raised another part of that discussion, which is the superannuation money is
Mm.
clearly just this resource that people have started to wake up is there. They've got part of their
Yeah,
mandates, this incredible, PE part of their portfolio mandates to tap
yeah,
into. Is
yeah.
this what's, part of the revolution is that, Australians are one of the highest contributors to, retirement savings with 12% of your weekly earnings going there.
Mm,
They've got to allocate it somewhere. I mean, I think that's also part of your answer to way back with the first question about passive is that, super
mm.
funds get 12% every single week
Yeah,
and
you
they've
get
got to
revenue growth of 12%, and you don't have to do
you
anything
you don't have to do anything,
to
right?
get that. Nothing.
So,
All you're doing is just compare. Like the industry is going to get that money. It's just a question of where it goes.
yeah.
It's like a
And so
beautiful tailwind.
is that the future now with regards to that private capital that we need to understand as, you know, not just investors, but just basically as average Australians in the market, which is that your superannuation now is probably creating a market you wouldn't normally get access to through
Mhm.
capital. Does that excite you, or does it also therefore mean that it becomes more and more opaque and therefore more and more, of that incredible capital that we should be applying is just disappearing behind closed doors?
Hmm. Yeah, that's a good question. I haven't really thought about that too much. I think
Mm,
generally you would like. There's something good about having companies that are like important businesses, popular businesses being publicly listed and people being able to buy and sell those businesses. There's a transparency to it that I think is valuable, that you don't get in private markets. I fully understand why you would rather go private. Like we work for InvestSmart. I'm sure sure the owners of this business would like it to be private. I don't know. um, so it is a problem, but the superannuation money's got to go somewhere, and you can make the argument you don't want to put it into public markets right now because everything's pretty expensive. Why wouldn't you put it elsewhere? You have to. You can't sit on it, right? We're not paying people to sit on cash. It's got to go somewhere. So whether the government could come up with some scheme that allows you to fund smaller businesses like that, I don't know. I don't like the idea of government getting involved in that sort of thing.
it goes back to your
But
bureaucratic question, right? So
that's right, yeah. But maybe you allocate, and some of the super funds I'm sure are doing this, you have a small part of your portfolio, which could be a hell of a lot of money that you can use to fund much, much smaller businesses.
it'd
And
be
you have a
remiss of
kind of
me,
speculative venture capital division.
yeah, it'd be remiss of me not to get you on here and talk to you about your latest book, which is How Not to Lose $1 Million. What brought you to actually writing a book around not losing $1 million? This
It was
experience,
a
or
moment of madness, Evan. As you know, you've written
yes,
a
I do.
book, and like, why
I
would you
have
want to
written a book.
do that?
Take me through it.
Well, everything that you read in investment publishing is about how to make $1 million, how to be successful, how to do it right. But a major part of doing things right is learning from your mistakes. And I think the reason why the industry doesn't like talking about its mistakes because they want to pretend that
They
nobody,
don't
like
happen.
the best people don't make them.
Yeah.
And it's obviously bullshit. Like all of our mistakes are out there, in the public domain on our website. There's no hiding from that. So I thought, well, if you can get better at making mistakes, your portfolio performance is going to improve. And the difficult thing about being successful, say with a particular investment, is you tend not to learn much from it.
Mm.
And there's not that much there to learn. But when you screw up, there is a massive amount to learn, but we tend to shy away from it. So the reason for the book was to sort of dig deeply into those mistakes, how we got them wrong, what the source of the mistake was, and often it's multiple sources, and really sort of air all of that dirty washing in the hope that people would read it and see some of their own mistakes and go back to them and reflect on them with the idea of becoming better investors as a result.
Because the reason I wanted to ask you that question, because it highlights one of the things I wrote in my book of that is the most prevalent thing that I see, particularly in our world, because we come across a
Uh-huh.
lot of egos. It's what it is, but it's also
Yeah.
the fact that self-attribution bias, as it's classically
Right.
referred to,
Right.
is just so strong.
Rampant.
Yeah, it's so strong. So obviously the whole concept of self-attribution is if I get it right, it was me. If I get it wrong, it's the environment. I mean,
Right.
that's the simplest way to say what self-attribution bias is.
Yeah.
And you're right, human beings don't like admitting that they've made a mistake because that would,
Mm.
there's a whole tendency for that. So then I then have to ask, what if yours was your biggest one? Because I
Oh,
remember mine.
go on then. Tell me about yours, and
So
I'll
my
think about
biggest
mine.
one was when I was completely fresh, proper fresh
Yeah.
into this
Yeah.
world. And again, I will put my hand up and say very clearly, publicly, that my self-attribution bias was through the roof in that I thought I'd done all of this research into, and I'm going to name the company because it's still about, but it's as it was then too, which is Bort Longyear, or Boat Longyear,
No.
depending on
Yeah.
how you want to pronounce
Yeah.
it.
Yeah.
They were at the time doing so many capital raisings. They were really, really driving their oil digging business and their prospecting business throughout Australia, North Asia and America. And the sell was incredible. They had a very low, PE, all the fundamentals that had come with it. And I remember going real hard into Port Longyear, and my word, did it bite me. And it's to this day, I will put my hand up. It is the biggest mistake. I'm pretty
When you say
sure.
going hard, you mean your portfolio allocation.
But yeah, portfolio allocation was hard. So I'm pretty sure I remember
Mm.
picking up about $4.20
Mm.
and finally admitting that the mistake was on me, not the environment, when it got down to
Mm.
about $2.10. So,
Right.
half, right?
That's
50%
not so
decline.
bad.
Yeah. But for for me at the time, I would have been in my early mid-20s, I reckon, when this
Mm-hmm.
happened, when I, first started to say that this is what my vocation would be. That
Yeah.
to this day is, and I will openly tell anybody, then everybody said that was the realization that the old adage, you know less than you know, and the older you get, the more you realize that you know even less.
Yeah.
Was the first slap in the face that was actually not just true, but it was more than true in the fact that
Mm-hmm.
you will never know everything. The whole concept of market pure information and whole understand is a theoretical construct, right? Nobody can ever have perfect information, even with AI going forward. That
Mm.
was the day that I woke up that behavior is in my world, the biggest driver of market behavior, economic behavior, money behavior was just
Yeah.
understanding that.
Right. I think that's true. I mean, as a broader point, like we all like to rationalize logic,
Mhm.
but most decisions have an emotional foundation, and that's what brings us undone.
Yep.
So I'll bring you to my one. It's not in the book, this one, because it was so embarrassing. I didn't want to talk about it.
So now
It
you're
would have
just
been
talking to me.
about. No, so it wasn't really. I mean, it's kind of an ordinary mistake, but I put a lot of money into this gold stock called Croesus,
Right.
and I knew that the risks were. Um, And the reason there's as with every mistake, as with yours, there's more than one or two things going on. But we had a resources analyst who was very, very smart, very knowledgeable, trained geologist, and almost everything he touched sort of turned to gold.
Excuse the
And
pun.
he recommended this stock, and I thought about it. So gold isn't really my thing, but I really trust him. And I went big on it, to use your expression. I
Mhm.
went in deep, and I knew that there was a risk because they had these hedging contracts, which were quite onerous. But it seemed to be a well-managed kind of business. The gold price was fine. It seemed to be okay. Just about everything that could go wrong did go wrong, and the banks called in and shut the company down. I think I lost about 300 grand, which would have been like back in the early 2000s.
Yep.
And it was way, like, I think that would have been like double digits in my portfolio easily, maybe over 20%. I don't know at that time. And it didn't go to zero, but
near
you know
enough.
that the ASX has that unmarketable parcel thing, like if you have own
Yes.
less than $500 of a stock.
Yeah, they just close it
So they
out.
wrote to me and said that you've got less than $500 unless you sort of increase your holding, we're going to force you to sell. So I thought, I'm glad to see the back of that. Anyway, so that stock was sold in my portfolio, and 2 years later, that stock was the biggest performing stock on the ASX after it relisted. I forget the name of it now. It went up 36,000%, and had I hung on to my $500 stock, I would have made a fair bit of my money back. So that was a disaster. But it wasn't wrong to buy that stock. The thing that was wrong about it was portfolio allocation. And I think this is one of the things that we do. We go, what was wrong with that management team? What was wrong with that product? What was wrong with that company? Well, you can manage a lot of the risks in your portfolio by not being overexposed to a company that contains all of those risks. That stock should have been 2.5%, 3% of my portfolio. And it was, getting up towards 10 times that.
Yeah. So realistically, instead of 300K, it should have been at most 30K.
Yeah, it's just been greedy, right? Because you're going,
Yep.
oh, this could go up 4 or 5 times. That's a lot of money.
Yeah, you and I could talk about those kind of things till the cows come home. But I am very, very aware I'm running out of time. So I'm going to ask you the question I always ask all of my guests. John Addis,
Right.
if you're in charge for just one day, what would you do?
Yeah. It sounds like a practical thing, but it's not really legislation. Like, I'm tempted to say legislation. I'd love to get rid of the Business Council of Australia. I think they are just the most obnoxious rent seekers in the country. But what I would do
Can you expand on that before you answer? Just expand on that.
Well, look at their members. Most of them are sort of foreign multinationals. Look at the tax that they pay. And whenever there's a problem, the answer from the BCA is always lower corporate taxes. And they're not paying any tax anyway. And they're going to be there this week making that argument, because that's the only argument they ever make, like lower regulation on workers and lower corporate tax rates. That's all they ever say. I just don't know why the government would bother to ask them there. Everybody knows what they're going to say. They've been saying the same bloody thing for decades. And honestly, I think they are the worst lobby group in the country. Like, they're just so boring, so predictable, and so self-interested. That's all they do. Just propagate the same old bullshit. Anyway, that's my rant about the BCA. Really have no time for them.
Love it.
The thing that I do is I would mandate people to worry less.
Yeah. Okay. Yeah.
I think we worry way too much. It takes up way too much of our mental space. We internalize a lot of that worry that expresses it in some kind of physical problems. And we live in a rich country. We live in a good country. We have, despite all our frustrations with the politicians, we have a very stable political environment. And most of us, the vast majority of us, despite struggles with the housing market and jobs and all the rest of us, lead probably some of the best lives in the world. And even when things go wrong, we still don't get forgotten. We have ways of fighting back and coming back. And we spend too much time worrying about those things. And usually it doesn't happen. And when it does, you'll come back. So stop worrying.
That is a beautiful way to finish an incredible exchange. John Addis, thank you so much for joining us today.
Thanks, Evan. That was great.
Big thank you to John for having on. I've always loved having our conversations. The discussion, the exchange are always quite robust. And as you can hear, we certainly enjoy getting on with each other and having a really, really good conversation. To you out there, thank you as always for listening, watching, or everything in between about how you're getting hold of exchanges. Don't forget, there is an email. It's exchanges@evanlucas.com.au. And wherever you are listening or watching, please hit the subscribe button. Give us a rating. The more we get, the better we can get with guests. It is absolutely humming along, and thank you for that. If we can keep growing, that would be fantastic. But until next week, thank you as always, and we'll talk to you then on Exchanges.